Good morning and welcome to the Pinnacle Virtual Summit 2020. My name is Ramsin Jajoo and I lead the retail business at Pinnacle. Many of you have been long-term supporters of Pinnacle and our boutique investment partners, are aware of our annual summit program, and we thank you once again for participating in this year's event. For those of you who are first-timers, welcome. We run this program each year in a short and succinct format. We showcase the very best of our leading and highly regarded active investment managers. And this year will be no different. Our managers will be tackling some of the key issues that are facing investors today. Now, we are hearing from you in the marketplace that there is some fatigue settling in with respect to the sheer volume of digital content that is being served. So we've been very mindful of your precious time and have pulled together a curated program with the support of all the major research houses to deliver on three key objectives this week. Firstly, we want to thank you and provide you with a very relevant and very deep insights from subject matter experts. We have our CIOs, our portfolio managers, and of course we have researchers to help you more critically evaluate the markets and the investment environment that is rapidly changing. What should your attention be focused on during this challenging time? Secondly, if each of you can walk away with just a couple of ideas each day on how you can change or refine or introduce new ideas into your investment philosophy and process, then we believe we have success. Thirdly, we want to help you build more tailored and robust portfolios that are suitable for these unprecedented times. Delivering on these key objectives are ultimately in line with Pinnacle's own mission, which is enabling better lives, to enable better lives for investors through investment excellence. Of course, that investment excellence will be showcased this week. Now, just before we kick off today's session, a quick bit of housekeeping on the platform that we are using. The On24 platform you're logged into is customizable, so you can personalize your experience. You have the ability to enlarge or minimize any of the widgets on your screen so that you can zoom in into either the presentations, you can focus on the presenters themselves, you can even hover your mouse over the media player where you'll see the volume dial pop up, and you can increase or decrease the volume to your taste. The other good news is that you can download the presentations material at your leisure from the platform. We invite you to ask questions throughout any of the sessions. Please take that opportunity to engage, and our commitment is that we will try to get back to all your questions today. Now, in terms of this year again, we have partnered with Portfolio Construction Forum for the CPD hours. Please click on the CPD link on your dashboard to go directly to the PCF site where you can start completing the accreditation process for CPD hours straight away today. You don't have to wait for a few weeks. You will also notice a direct donation button for our charitable foundation, who is supporting charities doing incredible and necessary work during these very challenging times. We're very excited to announce that any donations we receive during the virtual summit will be doubled by Pinnacle, up to a total of $10,000. If you would like to find out more, you can click on the link on your dashboard. Now, in terms of today, so let's get the show on the road. We are focusing on real assets. In terms of today's program, we're doing a deep dive into the real assets sector. For as long as I remember, advisors, in fact, institutional investors, have been searching for less correlated investments that can introduce true diversification benefits for clients. This commitment to building more resilient portfolios that can withstand the test of market dislocations and deliver smoother investment journeys for clients has seen global pension funds, industry super funds, and some private wealth firms allocate up to 25, maybe 30% of their portfolios towards this asset class. Well, over the course of the next hour and a half, we'll learn from three of our affiliates what unique capabilities and benefits they bring to help you deliver better outcomes for your clients. Now let's turn to our first manager this morning, Resolution Capital, who will cover the Australian listed real assets sector. Resolution Capital is perhaps the creme de la creme amongst our affiliates and has received the highest ratings from research houses on their G-REIT capability. Both Lonsec and Zenith have them highly recommended, and Morningstar assigned a gold rating, stating that they are simply the best. So in terms of their latest strategy that went to market, the Australian Real Assets Strategy, that also received a recommended rating from Zenith in its first review. Presenting today, we have Jan de Vos, the portfolio manager for the Real Assets Strategy. Jan has 15 years experience in global listed real estate markets and will discuss the benefits for investors in having a liquid exposure to high quality Australian REITs and infrastructure assets, which provide a broad investment universe, including airports, indeed pipelines, and essential real estate that can improve the overall risk-adjusted return for client portfolios. Now, welcome, Jan, over to you.
Thank you for that introduction, Ramsin, and good morning to everybody. My name is Jan de Vos, as mentioned, and today I would like to talk about the listed real asset opportunity, but also the pitfalls to avoid and how the portfolio is constructed. First of all, looking at this slide, you can see that listed real assets is a broad opportunity set. It ranges from pubs to childcare to toll roads and petrol stations, for example. So a broad opportunity set is important because the first rule of fishing is fish where the fish are. Hence, this way we can avoid areas where the prospects aren't very good and instead focus our attention on areas where the prospects are much better. Hence, a broad opportunity set is important. However, you can also see when you're looking at this slide that it's very obvious how these companies make their money. It's very transparent. This is not like an algorithm which generates your profits. These are tangible assets and they produce very long duration cash flows. To be clear, the fund is invested predominantly in ASX listed securities, including dual listed ones, but has the opportunity to invest up to 20% offshore. We also hope that this opportunity set will increase when cash-strapped governments around the world will sell assets to fund the deficits which they have occurred recently. The big advantage of listed is that it's liquid. So not only can you invest when you want to, even more importantly, you can sell when you need to. So there's no big queue with a long wait period to get your own money back. So on the left-hand side, you can see the A-REITs and how they trade versus net tangible assets. Well, typically, they're trading at a premium to net assets, but currently a discount. On the right-hand side, there's a similar graph for infrastructure. The blue line is listed, and the red one is unlisted. And typically, unlisted is trading at a premium to the listed market. This is particularly the case for the transport assets, the ports, the toll roads, and the airports. For example, last year, Macquarie sold a stake in Hobart Airport for a high 20 times EBITDA multiple. This is much higher than what typically Auckland or Sydney Airport trade for. So we believe that real assets can deliver really good returns for investors over the long run. However, there's a number of pitfalls to avoid. Probably the most important one is leverage. You really need to avoid too much leverage because that can kill an investment. When you have a forced to recapitalize at the bottom of the market, leading to permanent impairment of capital. Unfortunately, many A-REITs experienced this during the GFC. However, pleasingly, many A-REITs have really cleaned up the act and currently the balance sheet is in much better shape. Poor governance. Well, this one is rather obvious. If the management is not aligned with shareholders, then the return for shareholders over a long period of time won't be good. Yield obsession. And that's more from the investment management point of view. Dividends are important. They're an important part of the overall total return, but they're not the only point. And some investment managers focus too much on the starting yield of the product. And we think that's not right. I mean, it's easy to generate short-term high yield. I mean, you just buy a couple of assets and lever them up, particularly some bad assets. That works for some time. However, creating real value is much more difficult. So we focus on long-term distributions, not short-term yield. And I would urge you to have a look at some of those income products and compare them to, for example, our product. And also concentration risk. There's no such thing as a real assets index, but there's an A-REIT index and an infrastructure index. Unfortunately, concentration risk for both separately is too high. On the A-REIT side, 8 stocks comprise almost 80% of the index. Meanwhile, industrial, office and retail represent the majority of the index by asset class. And this is very different than what we experience globally, where some different asset classes have really come to prominence over the last decades. For example, residential for rent, healthcare, student housing, or telecommunication towers are big sectors globally, but domestically they're not available. On the infrastructure side, the good news is that the quality of the companies is really high on a global context. However, unfortunately, there's not too many companies in the sector. However, if you combine both, you're getting a great opportunity set and really can pick an interesting portfolio, we believe. So how is the portfolio positioned? As you can see, it looks quite different than a combined portfolio. Logistics is a large sector because it has its experienced tailwind from the e-commerce growth. But it's also a dynamic portfolio. For example, in the beginning of the year, office was double-digit part of the portfolio. However, currently it's a very small part. So what has changed? Well, obviously COVID. A lot of people are talking about working from home and the impact it's having on the office sector. We believe it is important, but there's something more important and more urgent currently. Namely, what happens in a recession, which we're currently experiencing? Office demand contracts. Meanwhile, capital values have already been high for a couple of years, which means supply is coming through. Not an enormous amount of supply, but enough to kind of make this supply-demand balance go in the wrong direction for landlords. In the beginning of the year, office conditions for the landlords in Sydney and Melbourne were arguably the best in a generation. However, currently, the vacancy rate in Sydney, for example, went from 3% at the beginning of the year to currently 7%. And both Sydney and Melbourne are on their way to double digits territory. So that will impact landlords' pricing powers. So hence, we kind of move away to other sectors. The sector which we find very interesting is, what you can see here, the third biggest sector, with the three ends. The triple net sector. So what are the nets? The nets are maintenance, insurance, and tax. So in this case, the tenant pays for that, but not the landlord. Particularly if you combine it with a very long lease, we believe this is very attractive, because many investors are underestimating the cash leakage which comes if you don't have that. Other important sectors are, for example, toll roads, utilities, airports, and digital assets. And in addition, the fund has 6% offshore exposure. So the stocks here are a combination of securities which are kind of similar to which ones are available domestically, but at a much better price, or securities which are simply not available in the local market. For example, student housing or telecommunication towers. So there's a couple of interesting themes in the portfolio. Critical real estate will always provide the bedrock of the portfolio. Meanwhile, e-commerce, so logistics and data centers provide the secular growth. What I found personally one of the most interesting thematics is the transition to the green economy. By 2050, we're supposed to stop emitting carbon, and that will impact every part of the economy. However, the sector most involved in the transition is the energy sector. So what needs to happen here? Well, first of all, electricity generation needs to decarbonize through the use of renewables. Second of all, lots of industries which currently don't use electricity need to use electricity. And the transport sector is a great example of this one, through, for example, electric vehicles. So all these themes are being underwritten by increasingly cheap renewables. For example, the cost of solar has fallen by 90%, that's 90 over the last decade. Meanwhile, wind has dropped 70%. Also, batteries are becoming much more economical. For example, the Tesla battery in South Australia is doing really well in terms of helping the grid, but also making their owners good money. So does it mean that we're really keen to be investing in renewables? And unfortunately, that's not really the case. Often we believe the returns are pretty skinny for what is actually pretty significant risk. However, there's a much better way to play this thematic from our point of view. And that's by investing in the good old boring utilities. Because all the solar farms and wind farms, they all need to be hooked up into the grid. So you need new transmission lines. Second of all, the system needs to increase its resilience. Hence, more interconnectors between the different states are necessary. So again, all these utilities can provide this in a relatively low-risk manner. So the portfolio owns Spark Infrastructure. This company has been going through a regulatory review process recently, and therefore its revenues and earnings are pretty predictable for the next 5 years. I think it will be difficult to find companies on the ASX which are more predictable than this one. So this company is giving you a 6% dividend yield and a 2% growth, which for the very low risk you're having seems pretty attractive for us, particularly because many investors seem to have difficulty finding good investments. Arena REIT is a REIT you might not be familiar with. It's one of the biggest childcare landlords in the country. And unfortunately, many parents of young school-aged children or children in childcare have learned the last couple of months how difficult it is to work from home and looking after your toddler, for example. These provide an essential service. Hence, they were also supported by the government. So what's unique about Arena REIT is it has a very long average lease length, 14 years. So that means the income stream is very predictable. For example, like last year, even during COVID, its dividends grew 4%. We think that's a very good run rate for the next couple of years as well. So if you combine a 5% starting yield with 4% growth, we believe that's a very attractive total return, particularly in the current return environment. So these are the type of companies we're looking for, simple compounders over many years. A very different stock is Auckland Airport. Many of you would know Sydney Airport and know that it has generated very good returns for investors over the long run. Well, we believe Auckland Airport is even better. So why is that? Well, first of all, it has a very high percentage market share of the international market. Second of all, it owns a lot of excess land. So it's actually one of the biggest industrial developers in the country. And this is definitely something which we like. It's also very much geared towards growth in Asia Pacific. It has not only population growth, but more importantly, it has wealth growth. And what you see is that when people enter the middle class, the disposable income increases, and they want to travel the world. And New Zealand is a great destination. So it's really geared towards that long-term growth. Historically, airports have been very resilient. For example, during 9/11, SARS, the GFC, air travel was actually pretty resilient. Clearly, the current period has been very different. However, we believe there's quite a bit of pent-up demand when people feel safe again. And New Zealand is actually a great example. In July, we saw like domestic travel in New Zealand being back to 60%, till, again, further lockdowns arise. However, we believe that Auckland Airport is a fantastic asset to own for the long term to really profit from this growth, particularly in Asia Pacific. So to wrap it all up, in a low-risk environment, we believe real assets are very beneficial. But you need to have pricing power. Hence, we are focused less on office and more on some other category which we believe has better risk-return profile. The portfolio is a mix between defensive attributes, but also the secular growth of data and e-commerce, and finally, like some of the COVID recovery plays, like for example, toll roads and airports. We believe that listed is trading at a discount to unlisted, which is very attractive. The relative of the performance of the fund has been very strong, but we believe the absolute resilience of the portfolio has increased because the AREIT sector is in a much better state in terms of balance sheet and strategy. Furthermore, with the addition of infrastructure to it, we believe the underlying cash flow are a lot more robust. And with that, I'll turn it back to you, Ramsin.
Thank you, Jan, for providing those valuable insights into why listed real assets make sense in the current low growth and low interest rate environment. You made a strong case for how listed real assets can deliver attractive income yields backed by cash flows from tangible assets. Later on, Jan will also be on the panel to discuss some key trends impacting this asset class. Dear audience, please don't forget to submit your questions. We will be answering them as we go along. Now we move on to Riparian. We will turn our focus away from the listed market and towards the benefits of investing in agriculture, food and water. Australia has developed one of the most functional and sophisticated water entitlements markets in the world. And to help us understand what are some of the key benefits and risks with this unique asset class, we have Riparian's Nick Waters. Nick is a co-founding managing partner of Riparian. He holds primary responsibilities for the day-to-day operations and water investment strategies of the firm. Besides his most apt and appropriate surname, Mr. Waters holds impressive credentials and all his bio is available on the platform. I'm going to hand over to you, Nick, in Brisbane, to tell us about water entitlements.
Yeah, thanks, Ramsin, and welcome everyone here today. Really glad to be able to present to you all here and hopefully provide you with a greater understanding of what water entitlements actually are and how, I guess, water entitlements, in our view, present a really compelling real asset investment opportunity, particularly in the current environment. So the Australian water markets, as we know them now, have developed into one of the most sophisticated and functional water markets around the world, and globally are really considered to be the gold standard when it comes to allocating this vital and increasingly scarce resource, which is water. Our water markets, again, since 2008, have endured a range of climatic and economic and political cycles over that 12-year period, and have demonstrated now a really significant level of resilience throughout those different cycles. The fundamental drivers of water entitlement values, which we'll discuss in a bit more detail here this morning, we believe provide quite strong tailwinds to water values and are unrelated, I guess, to those that drive traditional asset classes, which goes some of the way to explaining that logical low level of correlation that we've seen in water entitlement values over the last 12 years. So when we think about water, we think about it as being the irreplaceable input into irrigated farming, with farmers requiring water every year, regardless of seasonal conditions, so even in the wet periods. And that allows investments in water entitlements to really generate reliable annual yields. And our analysis of those yields over time has shown that they have been also relatively stable, and we haven't seen any signs of compression despite the recent run-ups in water entitlement values in the last 2 or 3 years. The regulatory framework that the water markets exist within continues to evolve, but the fundamentals of those regulations have really remained quite stable since the beginning of the markets 12 years ago now. So when we talk about investing in water in Australia, we really refer to two specific assets. So we talk about water entitlements and we talk about water allocations. So the first asset, water entitlements, can be thought of as permanent shares of airspace that exist in a particular dam. And each water entitlement has a specific security class. So they can be high security or they could be general or lower security. And that's shown by the images that are on the bottom of the slide that's on your screens at the moment. High security water entitlements represent the airspace that's at the bottom of the dam, which typically contains water, even in drier seasons, so even in droughts. Lower security entitlements represent airspace that's typically closer to the top of the dam, which may or may not contain water, and that's really driven by seasonal conditions. So basically, whether it's rained enough or not for the dams to be filled up. So if you hold a water entitlement, you have the right on an annual basis to be allocated a volume of water. And this is what's known as water allocations, or the second asset type that we talk about. The volume of water that you get allocated each year is really determined by the climatic conditions and whether or not there's water in your airspace. Investing in water then, from our perspective at a high level, involves buying the permanent water entitlements and then either leasing those entitlements out to irrigators or selling those annual water allocations we receive again to irrigators in order to generate income for investors. The farmers we sell the water to use that water to support their irrigated farming operations on an annual basis. Really importantly, as a concept of water entitlements, a really important concept to get across is that the volume of water entitlements on issue is actually capped, and that's come about as a result of a range of reforms that have occurred now over an extended period of time. This means that there's actually a limited amount of water available, and in fact the amount of water entitlements that are available for irrigators to access has actually been decreasing over time, and that's been due to government buybacks that have been done in order to support the environment. Given water is the vital and limiting input into irrigated farming, there's naturally really strong competition for this scarce and limited resource by irrigators, who are the main, obviously, users of water. The market structure that we have in place, that capped and freely tradable nature of water entitlements and the limiting nature of the asset itself, effectively means that water over time trades towards its highest and best economic use. What this means, for a simple illustration, if you think about having two farmers who are both requiring water, the farmer who can make the most money per megalitre of water used will actually outbid the other farmer and drive water values higher over time. What we like to say to describe this is that water flows uphill towards value. So what drives this market dynamic of water trading over time towards its highest and best economic use and drives water values in general is effectively the amount that irrigators are willing and able to pay for water. This capacity to pay for water has been increasing over time, and that's been due to factors like commodity prices that have been increasing due to demand for our produce, productivity gains that have been achieved by our agricultural sector, and conversion of farms from lower value to higher value cropping systems. These factors have not only led to an increase in capacity to pay for water, but they've also led to an increase in demand for water. And I guess simple economics tells us that when demand for an asset increases and the asset cannot provide a supply response to that demand because it's capped like water entitlements, then prices will rise. And this is effectively what we've seen play out since 2008 and what we really expect to continue to see occur as the areas that are being irrigated continue to increase, so the areas that are being planted by farmers expand, and farmers increase their capacity to pay for water for those reasons we just discussed, so productivity gains and increases in commodity prices. When we look at the fundamental drivers of water entitlements, we break them down into long-term and short-term categories. So long-term drivers are those that I just spoke about, so those productivity gains that Australian farmers have a long track record of being able to achieve. Commodity prices, which have been going up as a result of strong demand for Australian-grown produce, and increasing demand for water, which has been driven by that expansion of areas that are being irrigated. And in addition to this, we've seen reducing supply, which has been caused by both climate change impacts, but also through government buybacks over time as well. The main short-term driver that we see for water entitlement values is in relation to seasonal water supply conditions and changes in those conditions. So whether the season is wet or whether the season is dry. And as you can see in the chart on your screen, the long-term drivers of water entitlements have actually resulted in pretty strong gains in value along the way, which leads us to have a look at the performance of the markets since 2008. So the returns that are shown on your screen here are based on a basket of major Southern Murray-Darling Basin water entitlements. And as you can see, these returns have been pretty strong since 2008, with capital appreciation averaging almost 8% on an annualised basis over that period, and annual yields averaging at 4.1%. And it's these yields in particular, which are one of the key attributes of water entitlement investments that we think make them particularly compelling, particularly in today's low yield environment. And importantly, we see plenty of reasons as to why those yields can be sustained well into the future. This next slide really allows us to drill into the long-term drivers that we see of water entitlement values and to see where the trends have really been since 2008. So over that 12 years, the areas, as we discussed, that are being planted to higher value, often permanent crops like almonds and citrus and table grapes, have resulted in actually increased water demand on an annual basis, which, according to ABARES, has risen by over 3% per year over that period. The prices that our farmers have been receiving for their produce have actually been increasing over that period as well. And according to Rabo's Rural Commodity Price Index, that's been running at over 6% per year. And then according to ABARES again, our farmers have increased their productivity since 2008 by almost 2% per year. So there's some pretty strong demand side drivers that have been playing out over a pretty long period of time there. At the same time, the water supply situation has also been impacted by factors which include government buybacks of water entitlements, which we've seen occurring since 2008 up until around 2015. And they've acted to actually reduce the amount of water entitlements that are available for farmers to use for irrigation, and also impacted by climate change, which due to changes particularly that have been witnessed over the last 2 decades have led to really lower levels of inflows into the river systems and storages in the regions that we invest in. So in summary, we've seen over that period demand pretty steadily rising and supply falling at the same time. And this tight supply and demand dynamic is pretty well illustrated, we think, by the chart that's on your screens now. And this comes from an independent study done by a firm called Aether. The green bars on this chart show the annual demand for water in the Murray River system alone by just horticultural crops. And as we touched on that previous slide, since 2015, there have been significant areas, particularly in the Southern Basin, that have been planted to higher value, often permanent crops. And these crops can take up to 7 years to mature. These are almonds and citrus and the like. And as they mature, they require increasing amounts of water each year. This is expected to drive demand for water in the Southern Basin higher over the next decade, which is shown by those dark green bars that you can see on the chart. According to the analysis by Aether, by 2027, the amount of water required each year by these horticultural farmers in the Murray River region will actually be higher than the water availability in an average year, which is pretty important and critical from a supply-demand point of view. What's also important to note here is that the expansion of crops like almonds has actually created what we call a permanency of demand for water, as these types of crops require water every year, year in, year out, regardless of seasonal conditions and regardless of water prices. And this represents really a structural shift in the demand dynamics of the Southern Basin water markets, which today has far less ability to actually flex its annual demand for water than it did 10 years ago, before these crops really arrived. We don't believe this tightening supply-demand dynamic is fully priced into the water markets at this stage, and that again supports the rationale for investing in water entitlements at this point in the cycle. Looking towards the outlook for those long-term drivers that we discussed just before, so we expect all of these to be supportive of water values into the future as well. As discussed earlier, we continue to see increases in the areas being planted to these high-value permanent crops like almonds and citrus and table grapes, and we see that increasing the annual demand for water going forward, but on a permanent basis. The demand for Australian produce, Australian-grown produce, remains really strong, and that's even despite the current tensions with China. So we're expecting that to continue to support the prices being paid to our farmers here in Australia longer term. Aussie farmers are some of the most productive in the world, and due to the low levels of government subsidies and support, are fully incentivised to continue to deliver the productivity gains that we've really seen them deliver over the past 4 decades, according to ABARES data. And then finally, when we look at the supply conditions, these are expected to be increasingly challenging moving forward, and that's largely due to climate change impacts. So when we consider these drivers of water entitlement values, it's really not hard to see then why water investment returns have exhibited such low levels of correlation with traditional markets, which is shown on this slide on your screen now. So when we boil it down, water markets are effectively driven by how much farmers are willing and able to pay for water, which is obviously completely unrelated to the drivers of traditional markets. The outlook for the longer term drivers that we just covered of water entitlement values suggests to us pretty clearly that these low levels of correlation are likely to continue well into the future. So then looking more closely at how we generate returns investing in water. So we've covered, I guess, in reasonable detail now the drivers behind the capital growth aspect of the return profile. And the diagram on your screens now also illustrates how we generate annual income from a portfolio of water entitlements, which you can see listed down the right-hand side of the chart. And these factors enable investors to receive those reliable annual yields that we spoke about earlier. So we generate these yields through a range of activities, which include leasing water entitlements to irrigators or selling water allocations in the spot and the forward markets, again, to irrigators who use that water to support their irrigated farming operations. In combination, these activities have typically generated annual distributions to investors of between 4 and 6%. In the current low yield environment, these annual cash distributions, I guess, are yet another really appealing aspect of investments in water entitlements. So I mentioned earlier at the beginning of the presentation that the regulations of our water markets are well established now. And while mechanisms do exist for improvements, the framework has really been supported well by a range of reviews that have been conducted that are shown in the table on your screen at the moment. Probably the most important of these has been the findings of the current ACCC review into the water markets of the Murray-Darling Basin. So the ACCC released its interim report back in July this year, and it highlighted the importance of the water markets in general and the value that they've created to a range of stakeholders over a pretty significant period of time now. And also importantly, they confirmed the critical role that investors play in the function and efficiency of those vital water markets. The ACCC in its report also pointed to areas where the market infrastructure could be improved, particularly in areas around governance and oversight and transparent access to trade information. And all of these findings we really support, and we believe the ACCC report should really allay any concerns potential investors may have of being involved in the water markets in general. The key risks in relation to water investments we believe that investors need to be aware of relate primarily to agri-economic risks, regulatory risks and climate risks. So the agri-economic environment, as we discussed here this morning, remains really strong, and demand for food both here and abroad is expected to continue to support this, and we should continue to deliver strong prices to our farmers and enable them to increase their capacity to pay for water. Climate change is expected to support water entitlement values longer term. However, increasingly volatile weather events in the shorter term may have more of an impact on those short-term climatic drivers of returns that we discussed here a little earlier. And then in our view, any regulatory risks, as we just covered, have been significantly reduced with the recently released ACCC report. So in summary, we believe a diversified portfolio of water entitlements can provide investors with exposure to the broader Australian irrigated agriculture sector, which cover a range of different commodities and crops and the farmers that are actually growing them. The investments or an investment in a portfolio of water entitlements can provide an improved liquidity profile when compared with, say, traditional agricultural investments. And that's primarily owing to the tradable nature of water entitlements and the turnover in the water entitlement markets themselves. Having different entitlement types in the portfolio, so general security and high security groundwater and surface water, with a focus on leasing those entitlements to irrigators, acts to smooth out the annual volatility of cash distributions from season to season, providing more stable annual returns to investors, which at the end of the day are supported by that increasing demand for water and capacity to pay for water by those irrigators as well. And then lastly, as highlighted here today, in our view, the fundamental long-term drivers of water entitlements that have delivered such strong performance over the past decade remain in place today and are expected to continue to support the value of water entitlements well into the future, and by virtue of that provide returns to investors that are uncorrelated to other traditional asset classes, which is really important obviously in the current environment. Thanks everyone for your time. I'll just hand over back to Ramsin now.
Thank you, Nick, for sharing those expert insights and highlighting the case for investing in water as part of an overall diversified portfolio. No doubt, investors in water can benefit from strong tailwinds, such as rising demand from crop plantations, rising agriculture commodity prices, as well as other factors such as scarcity of water, especially water supply due to the climate change issue that we all hear about. Now we're going to move on to Palisade. We'll continue our journey into the private markets by looking into how unlisted infrastructure can solve for the challenge of delivering smoother returns for investors. Whilst unlisted infrastructure has traditionally been a difficult asset class to access for non-institutional investors, Palisade this year has come to market with some limited capacity and opportunities for our wholesale clients to access this attractive asset class. To tell us more, we are fortunate to have a very seasoned investor in Roger Lloyd. He's the Managing Director and CEO of Palisade, who's joining us to discuss how investors can benefit from an infrastructure-led recovery. Welcome, Roger.
Thank you, Ramsin. I might just start off with a brief overview about Palisade, who we are and what we're all about. We are a specialist unlisted infrastructure manager with a very simple focus. We are investing into infrastructure, mid-market infrastructure, and domestically only. ANZ is our market. And why ANZ? Very simply, we know the market, we understand the market. It's a very mature sector in the Australian environment. Australia were very early adopters of private sector investment into infrastructure, provision of infrastructure. And so it's a sector that we believe in and the market understands quite well. Why mid-market? There are a number of reasons, but the key ones for us are, it is a large asset base. We don't see capacity constraints in the market. There are a number of assets available in the mid-market that may not be available in the larger cap space of infrastructure. It is a lot less competitive, both in number of participants and also the cost of capital, which is important. And importantly, what we see as one of the major benefits of the mid-market is if we're acquiring an asset, we're generally acquiring a large share of a smaller asset, which will then give us the control, the active management capability to generate and maximize returns from those assets. So that's the key reasons why we're involved in mid-market, is that greater control, influence over, and active management of the assets to drive the returns. Palisade itself, we're managing close to $3 billion in equity in infrastructure assets and 24 assets across the country, Australia and New Zealand. All states and territories are covered in that regard. We've got a very large team of investment professionals focused purely on investing and managing those investments. We run three funds. The Diversified Infrastructure Fund that really has got access to all of the assets in the portfolio. We've also got the Renewable Energy Fund, which has been a long-term investor into renewable energy since 2008. And the Australian Social Infrastructure Fund, investing purely into public-private partnerships. That's government revenue streams. So each of those funds are open-ended and are in the market for capital, and are opportunistically buying assets that become available in the market. So taking a step back now, what is our investment philosophy and what are we looking for from infrastructure? The key to us is protection of capital, number one. And you can achieve this if you recognize that infrastructure is an essential asset. Essential assets and facilities and services that actually generate and contribute to the efficient functioning of our economy. Number one, if you need defensive asset class and essential, those two go together. We're then looking at the broad spectrum of infrastructure, so across economic and social, but within that you've got economic assets such as GDP-linked assets, your transport type assets, ports, airports, etc. Your contracted assets, which make up the majority of our portfolio, and regulated assets where you're relying on an independent regulator determining your revenue stream. We look across that spectrum and generally favour the economic and contracted side of things. But it's not a homogeneous asset class. We look at detail around both the business and financial fundamentals of each asset in the class within the asset class. Firstly, we're looking for long duration income streams, most importantly. Many of our assets will have 20, 30, up to 99-year concession terms. This is very important for an open-ended fund, and very important that we actually seek long-term income streams from the assets that we are investing in. We look for limited competition of that asset in the market that it operates, and we're also seeking limited operation risk. We want to ultimately convert this into financial fundamentals that show that we've got high EBITDA margins, so very strong, not exposed to a lot of operating leverage. They're generally high capex items, which lends itself to the long-term nature of the asset. And also we're looking for high correlation to inflation. The current portfolio runs at around about 0.8, so very closely correlated to inflation, and a low correlation to other asset classes, which we're getting from infrastructure as an asset class. We then combine that with active management. These are not bottom drawer assets. They need to be managed through their life cycle. And so we do adopt a very active management strategy with our assets. And ultimately what that's going to do is provide for the investor a long-term sustainable cash flow. That is the other principal objective that we seek from infrastructure as an asset class. So moving on to the sectors that we have as preferred sectors, and it's quite satisfying, this chart, because we've been invested now to that roadmap, accessing what we see as the preferred sectors. And you can see in bold on that slide, the sectors that we have actually managed to invest in, recognize it's an opportunistic sector. We've actually managed to really expose our investors to the full scope, full spectrum of infrastructure investment. The diversified fund has got access to all the assets we manage. The renewables are getting access to it's also getting access to renewable energy through our renewable energy fund and PPPs through our social infrastructure fund. But recognise that these are real assets that Jan talked about earlier as well. You know, you'll see down the side there we've got investments in the Port of Portland, we've got investments in agri-infrastructure assets through our regional livestock exchanges. The Gold Coast Light Rail, a public-private partnership, a revenue stream asset, not patronage-based, but a revenue stream. Make it available, the government pays. These are real assets producing real yield year on, year out. And it is a very diversified portfolio, not otherwise available in the market. So how do we build our portfolios and enhance returns from the portfolio? First of all, as I said, we focus on those sectors that we see as attractive, and that changes from time to time. And then we build out asset platforms. As we get involved in a sector, we need to ensure we leverage that sector, our expertise, the intellectual property that we actually have invested into that sector, and then build out that platform. And we've done that successfully now across the various sectors we're involved in. We were involved in gas pipelines, where we have two gas pipelines in the portfolio. Renewable assets, I mentioned before, is something that we have been involved in for a long time. We now have 5 assets generating 750 megawatts of power and abating millions of tons of carbon dioxide per annum. We're involved in public-private partnerships. We've got 7 assets in that. So that platform approach is very, very important. And what we also see within that is that within the assets themselves, we see bolt-on acquisition opportunities presenting themselves. Generally, they will be able to provide a lot higher return than simply getting involved in competitive auction processes that are often done at very high earnings multiples. When we're involved in the mid-market with both initial acquisitions but also bolt-ons, we can generally do those at 10 to 14 times earnings. That simply translates into 7 or 8% yield, and that's what we deliver. The next 3 slides look at what this means for returns available to our investors. Firstly, those relative to other asset classes, and the highlighted returns of the diversified fund against all asset classes on this slide demonstrate that we are able to produce top quartile returns and have done for 5 of the last 9 years. And this will continue. This is around volatility, this is around protection of capital, this is around making sure that we're involved in a defensive asset class and continue to be so through a diversified portfolio. The second chart looks at drawdowns, and even in recent downturns, as you can see, where we've had a small drawdown of capital, a very modest drawdown compared to other indices. And this is very important. This is around protection of capital throughout cycles. And lastly, a chart that I really do like, importantly, very importantly, over the long term, we have shown that we can generate very strong sustainable growth with very little volatility in returns. And we're very proud of these returns to be towards the top of the various indices on this chart, but also just demonstrating the very low volatility of those returns. So where do we see the future? Obviously, with the COVID-19 environment in which we're currently in, we are seeing opportunities arising from various spots. This is business as usual for us. We are not seeing a slowdown in investment activity. If anything, the opposite of that. There are continued opportunities in the market that we're looking at, and they're rising through a number of places. We've heard a lot about the infrastructure-led recovery. That is meaning that governments will be freeing up capital and looking for private sector co-investment. And we're seeing that already. Shovel-ready projects are accelerating in terms of their delivery, and we'll attempt to be a part of that. We also expect to see a little bit of distress. We haven't yet seen that in the market, but we do see distress coming at the point when potentially the banks will lose patience, potentially with lower quality assets, or potentially more highly leveraged assets. So we do expect to see some distress coming into the market in the near term, and by near term we're talking about 12 to 24 month period of time. The other thing we will see is corporates looking at their balance sheets and moving away from non-core, and we've assisted in that regard. Last year we did a transaction with GrainCorp where we took an asset off their balance sheet which more suited the lower risk, lower cost of capital solution that we're looking for. And the other thing that we're seeing already entering the market is take privates. A transaction recently done by one of the super funds was to take a telecoms business off the market. We can see an acceleration of that as well. So there are a number of opportunities in addition to just the traditional means that we do, which is actually seeking out assets in the market that fit our long-term roadmap. So there's a lot of information on the slide. I think you do have the function to actually blow it up. It might be worthwhile doing so with this slide. And I'll just take you through the key elements of that. Firstly, on the bottom left of the slide, the chart there really describes a highly diversified portfolio using the platform approach that I talked about before. 24 assets in the portfolio. As I say, probably one of the more diversified portfolios in the market in the unlisted space. We don't have a massive overweight towards airport or toll roads, which many of our peers do. Deliberately, we are setting out to actually get greater diversification. And one way we look at it is around revenue streams. You'll see that we have got very highly contracted. Majority of our revenue streams are actually highly contracted with good creditworthy counterparties, and that really has held up and provided us the resilience that we want from the portfolio, particularly during these times, where airports in the past have been viewed as a market favourite. Obviously, they've been tested in this market, and therefore that focus that we have on making sure that we have a diverse range of revenue streams has provided us with that resilience. And lastly, it's for us providing strong, robust cash flows over the long term. As I mentioned, the principal objective is capital protection, and you'll see over 10 years we have achieved total shareholder returns in excess of 12%. Year in, year out, we are achieving those sorts of returns, and importantly, a large proportion of that is towards yield. As I mentioned before, if we're able to actually acquire assets in the 10 to 14% EBITDA range, we are going to be able to generate yields for our investors of 7.5%, 8% plus, and that is a key goal of ours. And we do expect that to continue. The last chart that I'll point out is that on the bottom right, and that is our forecast, both forecast returns, both in terms of yield, being the columns, but also our total return. I call it 7-11. 7% yield with 11% total shareholder return over the long term, and it is the long term over which we're investing. In a nutshell, that is Palisade, and as Ramsin mentioned at the outset, we now have, despite the fact that we have a largely institutional base, we are now open to the wholesale sector to provide the non-insto market with the yields and the long-term returns that we have generated in the past and expect to generate in the future. Thank you.
Thank you, Roger, for that comprehensive overview of the unlisted infrastructure asset class. I like the 7-Eleven, it's quite catchy. So audience, I think we've had a wonderful morning and a start to this year's virtual summit. It takes me back to when I used to construct model portfolios and listening to Roger. It takes me back to why I had a very special affinity towards the unlisted infrastructure asset class. That predictability of income has always been attractive with that low volatility. I did enjoy Nick Waters' presentation, the true diversification from investing in water entitlements. It is a real opportunity to diversify in markets that can really be somewhat choppy. And of course, Jan de Vos, looking at real assets, a lot of Australian investors have typically invested in A-REITs, but to take the opportunity to broaden your investment horizon, there's a real benefit from a portfolio construction perspective. Now, this brings us to our panel session. And as I mentioned at the onset, we will take a couple of minutes break, but when we come back, we have asked the research houses to help us look at the different trends across the different asset classes. And today, we're going to start with Louis Christopher, who is the Managing Director of SQM Research. He'll be hosting the Q&A panel. We'll take about 2 or 3 minutes to set up the panel session, but in the meantime, I'll give you a little bit of background about Louis in particular. Now, Louis founded SQM Research back in 2006, and he is considered a market leader, not only on his deep insights on the property market, but he's also brought together a group of experienced researchers at SQM, who are typically the forefront of doing research on real assets. And of course, they do capture a lot of emerging markets, actually emerging strategies research as well. A lot of fund managers do turn to SQM to capture early research on emerging products in the marketplace. Louis is a seasoned veteran on the investor speaking circuit. He's presented on a lot of conferences. He appears regularly on various business channels. And I'm going to take a couple of minutes break, and when we come back, Louis will start with presenting his key findings on this asset class. We'll be back shortly.
having trouble, so I'll go back to the Q&A.
Had, but we're here with you now as I understand it. Now, as I was about to say, we live in very interesting times. And I'd just like to share with you just some of the performance numbers, both at the broader market level, the subsector level, and certainly at the investment manager level, because the variation is huge. And then after that, I've got a couple other points I'd like to raise, and we're going to get into the Q&A. Don't forget, you can still actually put in some questions, and towards the end of the session, we should be able to get to some of them at least. Firstly, let's consider some of the market moves that we've actually had. Firstly, the ASX 200. Peak to trough, the market's actually fallen 36.5%. So that's from just prior to coronavirus right down to the bottom. Now, the correction as we stand right now is at about 18.2%. The S&P 500. Peak to trough, the fall's been 33.9%. The correction now is only just 1.4%. So the S&P 500 over in the States has pretty much made up all its losses. The FTSE Nareit Global Index, which is something a little bit closer to this session, the peak to trough fall's been 39.3%. And the correction now has been about 28.6%. So it's made some of it back. Closer to home, the ASX 200 A-REIT Index, the peak to trough correction, 49.3%. The correction now running at about 26%. Now, to give you some perspective on that, back in 2008, the correction in the A-REIT Index was 75% peak to trough. It was a huge decline. This is, of course, a massive decline as well. And going towards global infrastructure, the S&P Global Infrastructure Index down 42.7%. The correction now, though, is 19.7 from prior to coronavirus through to now. And then finally, the S&P ASX Infrastructure Index, at one stage it was down 37%, and now we're down 18.3%. So you can see there's been some significant falls, and there has been a recovery. And this really does present challenges for investment managers as well as opportunities. Now, within that, of course, the subsectors, there's been significant variation just within the subsectors. So within infrastructure, we have seen, as Jan has covered before, that the airports, for example, have taken a big hit. There's been some recovery as well. Over on the property side, we all know retail's been hit hard. Offices have been hit hard as well. But industrial has actually done very well and is actually higher than when we started off with coronavirus. On the infrastructure side, we've seen utilities really outperform. Roads, well, they went into this downturn quite badly, but since then there has been a bit of a recovery with roads. As a result, there's been significant variance in returns by investment managers, and I think when you consider these numbers, you'll be pretty blown away. So with infrastructure-related fund managers, and generally speaking, they're mostly global with some domestic, the variance over the last 12 months is that we've had the best managers have a negative return of about -4, and the worst has been about -25%. That's over the 12-month period. Those funds which have been hedged, they've generally done better. And those with large emerging market exposure have done worse, a lot worse. When we consider global REITs, the variance in returns has also been significant. The best managers have got roughly a 12-month return now of about -7%, and the worst managers about -21%. The median's been about 15.5%. That's roughly where the benchmark's been. Once again, hedging has done better in this environment, which is quite the contrast to what we actually had back in 2008, 2009, where unhedged actually did a lot better. And then when we consider A-REITs, wow, Well, the best managers have done about minus 12% with A-REIT funds over the last 12 months. The worst one, and I'm not going to mention them, minus 68%. Yeah, it's a big number. Meanwhile, of course, direct assets and infrastructure, agriculture, direct property appear to have outperformed. But have they? So the issue we've got right now is, do we have enough transactions going through the market to really make a good judgment on that? And I'll be asking a couple of questions to Roger directly on that particular point. But it is fair to say that when we go back to the GFC, direct assets did actually outperform then during that whole time as well. As a response to coronavirus and the subsequent recessions, we all know governments around the world have been blowing up their deficits. And with that, have also seen falls at the long end of the yield curve, significant falls. Both these events have had major ramifications for investment managers, particularly over the long term. For example, are we going to see an increase in expenditure on public infrastructure or private infrastructure, or will we see actually a bit of a rollback on that? And with the long end of the yield curve, that really can have some major ramifications for investment managers when they actually do their valuation modelling within their stocks, and as well as hard asset managers as well, when they're trying to work out fair value when they're considering buying a major infrastructure piece or a major piece of real estate. And what of the increasing political tensions between the major economic powers? How are such tensions impacting upon the sector? Let's keep in mind that we're going to have some new Foreign Investment Review Board rules coming in early next year. Will this mean that we're going to see less buyers in the market? And then, of course, let's consider some of the recent tensions around water rights that we've seen. It's certainly become a bit of a political football, especially early this year when we had the drought. Plus, let's not forget Brexit. It's still there. It's still actually happening. And it's come up again in recent days. So I'll be very interesting to get the views of managers there. So with all this in mind, let's get stuck into the questions. And my first question is actually going to be for these two gentlemen here before us, Roger and Jan. Gentlemen, what has been the best portfolio management strategy in the first half of 2020? And have portfolio managers been changing their approach with the times? So I'm thinking, like, have you been making some major structural changes in your thinking towards investments and your current holdings? Jan, maybe you might want to go first.
Yeah. Thank you for that question. So look, thinking about investment hasn't changed, but if the circumstances change, then you change your portfolio, right?
Yes.
So I mean, what we saw at the beginning of the year with a big deceleration of the economy meant that we did change the impact of how we positioned our portfolio.
Yes.
So obviously we went more towards the utilities, the loan contracted pipelines, for example. We went into the downturn with not much retail, so it hasn't done that well. We were more constructive previously on office, but which initially held up really well, which gave us the opportunity actually to recycle into some other opportunities. So what we're quite keen on are some long-dated triple net exposures.
It sounds like as I mean, overall Resolution, as I've always known Resolution's been very sector focused. Sounds like that remains the same way.
That is correct.
But you've just been changing some of your weightings there fundamentally. That's really the only change.
That's correct, yes.
Roger, what's your view in terms of the big picture and in terms of how you look at acquisitions at the moment and your existing portfolio?
Yeah, well, for us, it's I wouldn't say it's business as usual, but it's as close to it as we can be. You know, we are investing for the long term. It's not we're not buying to sell. We're buying to hold these assets over the long term. So we are sure seeing dislocation at the moment. We are seeing disruption, you know, particularly to those transport assets which we've talked about. But our strategy is to invest, you know, over cycles. And while we may, you know, that disruption may impact some of our portfolio, I think the diversification is very important, and we'll continue that diversification. We haven't really seen a major disruption to our investment thesis through this. We have not seen an adjustment to the way we assess risk in particular assets. We obviously need to take you know, all risks into account. I think the portfolio mix, though, is what's really important, and we will just continue to develop along those lines.
Thanks. Jan, just quickly going back to you, and I mentioned some of that massive subsector variance that we've seen before. When you consider your portfolio, I know you're more sector focused, but are you still seeing a lot of individual variance between the stocks within, say, a sector? Let's say, for example, utilities. So are you taking any type of bottom-up strategy with the current markets at all? Please explain that part.
Yeah. So look, it's always a combination of bottom-up and top-down.
Yep.
So I mean, the last year of half year, returns have probably been more driven by the sector exposure. And the utilities have held up, as you know, much better than the toll roads.
Yep.
So we do try to look at the pricing between different types of securities. That's, in short, it's a combination of both.
Got it. Cool. Nick, this question is for you. Look, from a broader investor's perspective, I would say not too many people know about water rights, and I think you did well to explain what they are. I'm curious to understand from the legal perspective, what do you actually get in a water right? Is this a actual certificate, a legal certificate? Who writes that certificate? And how do you derive the returns from them? Maybe you can just take us through that a little bit, please.
Yeah, sure. Thanks for the question, Louis. So, look, from a legal point of view, the water entitlements very similar legal standing to land titles. Before the unbundling that occurred back in the early 2000s, when water rights were bundled from land, they actually sat on on land titles. So they sit on the relevant state registries. So they all have a water register. They're issued by the relevant state governments and backed by those state governments. But they are effectively a perpetual right, as I said earlier, a perpetual right to a share of water in a particular resource or a particular dam. In terms of, I guess, deriving returns from water entitlements, as I sort of covered earlier, I guess, in the presentation, there's two components to that. So there's the capital growth component, and that comes about as a result of those long-term drivers that we're investing in. So effectively, we're investing in the success of the irrigated agriculture sector and its ability to increase its capacity to pay for water and increase demand for water over time and drive those values of water entitlements up. And then there's the yield component, which we generate from a range of different activities, from leasing those water entitlements out to irrigators, and under that system they pay us a fixed fee over a period of time, say 3 years, and in return for that fixed fee they get all of the rights of that water entitlement in terms of those annual allocations. And the other method we use is effectively just selling those annual allocations we get by holding the water entitlements directly to irrigators, and that generates the income. Farmers need water every year, they're growing crops every year, there's demand for water every year. So those yields that we produce are quite resilient and pretty stable.
Thanks, Nick. Now I understand that these water rights are eminently tradable, but can you just run us through, like, what is the actual market? It's a centralised exchange, and how liquid, excuse the pun, are the water rights?
Yeah, sure. Thanks, Louis. So there's no central exchange for water entitlements. The vast majority of water entitlements or water allocation trades, for that matter, transact through a network of water brokers that have been in existence for some time. And there's a couple of major water brokers out there that have the bulk of the market share, but most of it transacts through water brokers. Most of the transactions occur irrigator to irrigator. In terms of the makeup of the ownership of the market, this was confirmed in the ACCC report was released recently. Around 90% of the water entitlements on issue are held by irrigators still, and the other 10% are held by investors like ourselves, and also farmers who have retired and keep those water entitlements in their self-managed super funds.
Understood. Thanks for that, Nick. Next question's actually for you, Roger. So, Roger, let's consider the falls at the long end of the yield curve. They've been fairly significant compared to where we were pre-coronavirus. They're effectively halved. How do you find with that? How do you find the ability to actually value hard assets? Like, are you reflecting that in terms of your acquisitions modelling? And with that, are you finding any off-market opportunities for bargains at this point in time?
Yeah, it's a very good question. As I mentioned before, we are actually investing through cycles, though. We're not just pursuing the yield curve. as the risk-free rates have come down significantly. We are looking to, as I said, long-term holds of these assets. So it's more to a long-term bond yield expectation. We don't want to be investing in a 1% market. We want to be investing into a 3 or 4% market. So that actually determines our pricing for transactions. And I think that's generally held up. Whilst we've seen some compression in discount rates for assets or expected returns from those assets, it has generally held up in the unlisted market, and people are still investing at discount rates, perhaps with some slight compression, but not the compression that you mentioned. And continues to be so. There's still appetite to invest at those levels. There's still vendors selling assets at those levels, and also, as I mentioned during our presentation, we're also looking to bolt-ons where we can actually achieve the returns. I shouldn't say of old, but the 10% plus returns from assets that we've been able to achieve over the past decade.
So would it be fair to say that, okay, when you're considering asset purchases, you mentioned the fact that, okay, it looks like we haven't seen too much compression, actually. I suspect in part this is a result of the fact that many investors are considering the risks of that ongoing incurring income stream right now. And in some way we'll say, well, there might be a little bit more risk attached to that, particularly surrounding growth assets. So would it be fair to say then the risk premiums have actually gone up overall?
Look, I think that's the way it's been done. We have all our portfolio independently valued regularly, and those independent valuers are definitely adding a risk premium to account for that. Was it to account for it or to take account of the reduction in risk-free rates? So we are seeing an increase in risk-free premiums, a dislocation factor, if you like, which is actually keeping values high. And I think just in terms of investors, we're not operating in a massively competitive market in terms of acquisition of assets. And I think generally our peers for whom we compete for asset acquisition are looking at the world the same as we are. We are looking for through cycle investment. We're looking at long-term holds, not just taking advantage of a short-term blip in the market. Well, is it a blip? Life longer. We're not taking advantage of those lower rates to impact our pricing.
Okay, thanks for that. Yeah, no, I mean, it's fair to say that, okay, in your modelling and maybe within many investment managers' modelling, and I guess with the overall market, risk premiums have actually gone up, haven't they? Do you see them coming down anytime soon?
Look, I think that's a fair observation. Modelling is an important part of the overall process, but it's not that because bond rates have dropped, we immediately increase all our price targets. So that's not how we work. We don't think it has been particularly successful, so it's fair to say that risk premiums are a bit elevated currently.
Yeah, very cool. Nick, just over to you, just having a chat about the yield curve. Do you think that interest rates have an impact upon the pricing of water rights at all? I mean, is there any relationship there at all, or is there just zero relationship? And if there is not much of a relationship, what in your mind really drives the pricing of water rights, not just on the long term, but on the medium to short term? Maybe you just run us through that.
Yeah, sure. Thanks, Louis. So there's definitely a relationship there insofar as it impacts the, I guess, the profitability of farmers and their ability to pay for water and their capacity to pay for water. But I guess it's only one of the factors that flows into that sort of agri-economic conditions that I talked about in the presentation as being a major driver of water entitlement returns. So again, if we think about those longer term returns, it's productivity gains that have been achieved by the ag sector over a long period of time, and we continue to see being achieved. It's expansion into areas or new areas of irrigated farming, primarily with higher value and often permanent crops like almonds again. And then also the commodity prices that we've seen showing really strong gains over the last 12 years, and again we're expecting to see that continue into the future. The range of different free trade agreements in place for Australian produce into a range of different trading nations, not just China. In terms of the short and medium term, I guess again the climatic conditions of a given season have a much I guess, an outsized impact on the water allocation value and potentially the yields that you can receive in a year. Obviously, when there's more water around, those water allocations are worth less typically, and when there's less around, they're worth more. So you can have a sort of a wet and dry cycle impact on the annual yields, but from a portfolio management point of view, the way that we mitigate that volatility is really around leasing those entitlements out again for that fixed fee I talked about earlier to irrigators, so that smooths out the income from year to year, and having a diverse portfolio of different water entitlement types, different security classes that give you different amounts of water in different climate conditions, but also having water entitlements in a range of different water markets themselves. So across the north of Australia and the south of Australia, which have different rainfall patterns and different climatic conditions at a point in time. But that acts to I guess, remove that or reduce that volatility of annual income.
Thank you for that, Nick. Gentlemen, back to you. Just straight out, what subsectors are you bullish on right now? Just think of those specific subsectors. Is there anything that really stand out that you're getting excited about, and maybe some of the sectors where you're still feeling bearish and need to stay away for a while? Roger, go for it.
I'll pick on two subsectors if I could. Firstly, renewables. We're very keen on the decarbonisation of the economy, pure and simple. We've been invested into renewables, over 12 years now, and continue to be so. Currently running a portfolio around about 750 megawatts. We're abating a lot of CO2 already. We all know that the decarbonisation is coming. There's going to be a retirement of coal-fired generation in the economy. We need to replace that. So it's renewables in all its forms. If you think about renewables, traditional investment sectors have been wind and solar assets. But we also recognise that we're in a transitional arrangement, transitional period, where we need to enhance, augment renewables with other sources of energy, be it gas, and gas will play a role for some time, but also around storage. And storage is things like Snowy 2.0, it's hydro storage. That is energy storage in its simplest form. Through to batteries. We're also very keen, perhaps a little bit longer term, on the hydrogen story. We see that as a massive export opportunity for Australia. Into our northern neighbours, into Japan and Korea, are also keen on hydrogen and will be looking to import. But that's also another energy storage mechanism in itself. So renewables, for sure. The other thing we've seen through COVID, and God, we all know this because we're on Zoom calls half our lives at the moment, is data and movement of data around the globe. We are invested in a data cable that connects the US through Hawaii to Australia and New Zealand, and one of only two cables that does that. And the growth in data over this period of time has just been enormous. Generally looking at around 40-odd%, 43% CAGR in data. That has blown through the roof 2 or 3 times that over this period. So we do like data and everything to do with data, be it towers, cables, data centres, etc. So we continue to look at that. A difficult sector to get engaged into, though, but something that we're quite keen on. I'll take those two for starters.
Fair enough. And Jan, over to you, mate. What are you most bullish on right now?
Indeed. Look, as mentioned in my presentation, there's a couple of areas which we think are very interesting. Look, I think it's always a good time to own critical real estate. So really the good properties with long leases, I think there's always a role for that in the portfolio. The secular growth, e-commerce, for logistics, data, for data centers and data communication towers is an area of much interest. But also what Roger mentioned earlier, the green economy. We think actually utilities, which some people might consider a bit boring, but actually will provide investors with a very predictable and attractive income growth profile.
Thank you for that. Now, Jan, I note from your presentation, of course, there's been some change within Resolution in terms of one of the funds you have, which was the old AREIT fund. That's moved now to expand into infrastructure, and as I understand it from your presentation, That was in part as a result of the concentration issues that we see within AREITs. Maybe you can just go over what your investable universe was before the change to compare to what it is now, so people really get a good understanding of how much it has expanded.
Yeah. So we believe like real estate is a great investment, but you need to have different flavors. And as you mentioned, look, in Australia it's probably a bit too limited. So adding infrastructure increases the universe, but almost doubles the universe. So it increases by around like 70 to 80%, depending on the day. But I think what's more importantly is that the quality of the companies, which actually it increases by. And I think those companies are very high quality, but also they provide a very different income stream. And the utilities provide very different income stream than the Transurbans or the Sydney airports of this world. So I think it's a great addition and makes the portfolio a lot more robust than it used to be.
Thank you for that. Now, my next question is for all the panelists here. And Nick, I might start off with you on this one. And that is that, look, as we know, there's going to be new foreign investment rules coming in at the beginning of this year. They seem fairly restrictive. What might be the impact of new foreign investment rules on your particular fund? Could you just run us through that, if there's any impact at all?
Yeah, thanks, Louis. So from a FIRB point of view, and I guess from an agricultural sector perspective, the new rules that come in from January 1 will really be a reversion back to the rules we had in place generally prior to COVID-19 and the short-term restrictions that were put in place. And those restrictions that we have right now have undoubtedly have an impact on the agricultural sector in terms of inflows of capital from offshore. So we'd expect that to return to more normal conditions from January onwards. We don't expect that to have a meaningful impact on either land values or water values, really. Land values have continued to trend higher over this period as a result of strong onshore demand from farming, big or large family farming operations and other corporates and institutions here. So we'd expect to see that continue, really.
Thanks for that, Nick. Roger, FIRB rules, have they been an issue for you in the past, or do you think they're going to be an issue for you in the future?
They're not an issue for us, Louis, as a domestic investor. In fact, generally, the Foreign Investment Review Board favours the domestic investor. Obviously, look, we've already seen these in place for a number of months now, and probably more importantly, we've also seen the restrictions that the COVID environment has had on offshore investors. We're just not seeing them in the domestic market. They can't due diligence assets. Look, I think it will favour the domestic investor for sure. Vendors are looking for certainty of execution, and it's very difficult if you're putting a conditional bid into a vendor that has a condition on the government allowing the foreign investor to invest into critical infrastructure. This is critical infrastructure. We've got to remember that. There's always going to be a question mark over the offshore investor. I think that will favour us domestic investors in this market for sure.
Don't you think, though, as a follow-up upon that, I mean, okay, you say no direct impact upon you, but surely come resale time, you may well have less buyers out there.
Sure, absolutely. I mean, absolutely, because the market is smaller. But it's fair to say that us as long-term investors, and I've stressed this a few times, we are investing through the cycle, not buying to flip. In the medium term, 5-7, we're there for the long term. That really shouldn't be impacting us. I mean, it's not how we think about investing.
Thanks, Roger. And Jan, very quickly, what's your view on the rules?
Look, I think it will have pretty marginal impact. But yeah, a certain type of buyer might not be able to buy. We saw, example, in the listed market, we saw that last year when a certain company tried to take private APA. So, and that was deemed too strategic. So, I mean, look, from my perspective, that was not a bad outcome. So I hate to see great companies go. So, I mean, but ultimately, I think it is a relatively marginal impact.
Thank you. Well, everyone, that pretty much wraps it up. We've run out of time here. We could actually have this session go all day if it was me, but I don't think everyone would want that. So I'd just like to thank the panellists for their time in putting the presentations together and answering all those questions. For the audience, please don't forget your CPD points. That's really critical that you claim those. And thank you for your time and attention. And for now, that wraps it up. Thank you.